Hi, my name is Pieris Marcou, and I would like to welcome you to our quarterly tax update brought to you by the Deloitte Cyprus tax team right here from the old town of Nicosia in Cyprus. The main aim of our quarterly tax update is to give you some high-level insights to major tax developments in Cyprus and a brief outline on developments around the world that may have an impact on companies operating from Cyprus. In today's webcast, covering the period from July to September 2015, we will look at changes in local tax legislation that were voted into law during this period. We will update you on a new tax treaty and protocol signed during the period and briefly cover some important international tax developments. We will close off with a quick reminder of the tax deadlines coming up in the next quarter. We will start with the local tax developments, that is, changes in tax legislation that have been enacted during the quarter ending 30 September 2015. During this last quarter, we had some important changes in the tax legislation that were eagerly awaited and which are designed to make Cyprus more attractive to the international investor. At the same time, changes were enacted in the laws affecting transactions in immovable property, which aim to revive the real estate industry. We had the following amendments during the last quarter, with the main changes taking place on the 16th of July 2015, with the following tax laws being amended: the income tax law, the special defense contribution law, the capital gains tax law, and the Department of Land and Surveys, Levies and Duties law. These amendments, together with a number of proposed amendments that are currently pending the House of Representatives approval, are part of a joint effort of the private and public sectors to modernize the Cyprus tax system and improve Cyprus's competitiveness in attracting foreign investments. In addition, on the 18th of September, the payment deadline for the 2015 immovable property tax was extended through an amendment to the immovable property tax law. The first and most important change is that of the introduction of the notional interest deduction. Cyprus companies are now entitled to a tax-allowable notional interest deduction upon the introduction of new equity issued on or after 1 January 2015. The notional interest deduction is calculated by multiplying the new equity times a reference rate, and it cannot exceed 80% of taxable profit as calculated before the notional interest deduction, which means that the NID can reduce the effective tax rate of a company to as low as 2.5%. New equity is that of the qualifying equity issued by the company on or after 1 January 2015 and includes paid up share capital and share premium. And the reference rate is the yield of the 10-year government bond of the state in which the qualifying capital is invested plus 3%, subject to a minimum yield of the 10-year Cyprus government bond plus 3%. Here is an example of how the notional interest deduction would work. The top company will provide equity finance to the Cyprus company in exchange of shares issued. The equity issued qualifies as new equity, and as a result, with a corporate tax rate of 12.5%, the Cyprus company may decrease its effective tax to 2.5%. Another important change is the introduction of the domicile concept in the Special Defense Contribution Law. Before the 16th of July 2015, according to the Special Defense Contribution Law, an individual spending more than 183 days in Cyprus during a tax year will be subject to SDC on dividends, interest, and rental income. With the law amendment on the 16th of July 2015, the domicile concept was introduced. That means from the 16th of July 2015, an individual is subject to SDC if he or she spends more than 183 days in Cyprus, and at the same time is also considered domiciled in Cyprus. The tax effect is that a non-domiciled individual will be exempt from FTC on dividends, interest, and rental income, even if he spends more than 183 days in Cyprus in any tax year. An individual is domiciled in Cyprus if he or she has a Cypriot domicile of origin, subject to the following exceptions. An individual who has acquired and maintained domicile of choice abroad, provided that he has not been a Cypriot tax resident for any period of at least 20 consecutive years prior to the relevant tax year, or an individual who was not a Cypriot tax resident for a period of at least 20 consecutive years immediately before the voting of the law of the 16th of July 2015. In addition, an individual is deemed to be domiciled in Cyprus if he or she has been a Cyprus tax resident for at least 17 out of the last 20 years prior to the tax year concerned. We have prepared a decision diagram to determine the domicile of an individual. You may pause the video if you would like to run through the boxes to decide if a person is domiciled in Cyprus or not. The STC law has been amended to introduce certain anti-abuse provisions for three-tier structures. An anti-abuse provision has been introduced in the STC law in relation to the taxation of dividends paid to a company indirectly beneficially owned by Cyprus resident and domiciled individuals. According to the recent amendment, where an actual dividend is received by a company, in this case company B, which is indirectly owned by Cyprus tax resident and domiciled individual, and the Commissioner considers that the interposition of this company does not serve any substantial commercial or economic purpose, the Commissioner may deem that the dividend is paid directly to the Cyprus tax resident and domiciled individual who indirectly or directly controls the company receiving the dividend, and require the payment of the STC on the dividend either from the company receiving the dividend, i.e. company B, or from the Cyprus tax resident individual who controls the company. In an effort to revive the real estate industry, an amendment to the capital gains tax law was introduced, which provides for gains from the disposal of Cyprus real estate to be exempt from capital gains, provided that it is acquired within the period from 16 July 2015 to 31 December 2016 through a purchase agreement, i.e. is not exchanged or gifted, at market value from a non-connected person. There are no limitations with regards to the timing of the disposal. This exemption does not apply to property that has been acquired under foreclosure procedures. In addition, the Department of Land and Surveys law has been amended to introduce a 50% reduction in transfer fees. This applies to movable property transfers which take place until 31 of December 2016. The above reduction does not apply to transfers of movable property that have been acquired under the foreclosure procedures. In addition, the above-mentioned amending law also abolishes the provisions which resulted in a levy refund after 5 years from the transfer date on the following transfers: on transfers of immovable property from a partnership to a company having as sole shareholders the partners of the partnership, and on transfers of immovable property to a family company by an individual shareholder of the company or his close relatives, i.e. spouses or relatives up to a third degree kinder. Finally, on the 18th of September 2015, and according to an amendment made to the immovable property tax law, the deadline for payment of the immovable property tax for 2015 is extended from 30th of September 2015 to 31 December 2015. Furthermore, one of the following discounts apply if the tax is settled by 1 December 2015. A 20% discount for settling the tax due via the internet or at a licensed credit institution, or 17.5% discount for settling the tax due otherwise. It is worth noting that if the tax liability is not settled by the due date of 31 December 2015, an additional 10% charge will apply to the tax due. At the time that the law amendments mentioned in the previous slides were submitted to Parliament, a number of other proposals were deferred for voting. These amendments are expected to improve further the competitiveness of Cyprus in attracting foreign investments, but at the same time do include a number of anti-abuse measures. We highlight in the following slide the most important provisions of these proposals. Changes in the income tax law. There is a proposal for the extension of the 20% and the 50% personal income tax exemptions from 3 to 5 years and from 5 to 10 years, respectively. Also, there is a proposal to extend the accelerated capital allowances and, in addition, amendments to the main transfer pricing provisions to introduce a deemed deduction for expenses. The eagerly awaited foreign exchange tax neutrality. There is also a proposed amendment to limit the transfer of losses from intellectual property activities and the introduction of anti-avoidance provisions for reorganizations and hybrid instruments. In the capital gains tax law, there are proposals whereby gains on the disposal of shares of multi-tier structures would be subject to capital gains tax, and in addition to give power to the Commissioner to determine the consideration by taking into account the market value of the property being disposed. Finally, the Special Defense Contribution Law is expected to be amended to introduce similar anti-avoidance provisions for hybrid instruments as those that will be introduced under the income tax law. The long-awaited FATCA regulations were issued just a few days before the deadline for submitting the relevant documentation. Here are the details. On the 28th of August 2015, the Cyprus Ministry of Finance published a decree for the purpose of implementing the intergovernmental agreement signed between Cyprus and the US for FATCA purposes. I will remind that FATCA provides for the automatic exchange of information in relation to financial accounts held by US persons in Cypriot financial institutions. According to the decree, all financial institutions that fall within the scope of FATCA must retain all relevant documents used for preparing the relevant information submitted to the Ministry of Finance for a period of 6 years. During the quarter July to September 2015, we had the signing of a new tax treaty with Iran and a new protocol with Ukraine. In addition, the treaty negotiating team at the Ministry of Finance has been very busy continuing the momentum of negotiations with new treaty partners. Let's have a look at the details. In an effort to strengthen the economic relations between the two countries, on 4th of August 2015, Cyprus signed a tax treaty with Iran. According to the tax treaty, the maximum withholding rates are as follows: dividends 5% if the beneficial ownership is more than 25%, and 10% in all other cases, 5% on interest and 6% on royalties. It's worth noting that currently Cyprus does not apply withholding tax on dividends and or interest paid, and it is our understanding that neither does Iran. The provisions of the tax treaty will come into effect on the first day of January following the date the two states exchange ratification notifications. On the 2nd of July 2015, Cyprus and Ukraine concluded a protocol that will amend the existing tax treaty currently in place between the two countries. The agreed protocol is expected to come into effect not earlier than 1 January 2019. Finally, the Ministry of Finance is currently in negotiations with a number of countries, the most important ones shown below. For the international part of this quarter, I will briefly cover some recent developments within the European Union in their efforts for a more fair and efficient corporate tax system. The current lack of coordination in corporate taxation between member states creates obstacles for companies acting in the single European Union market. On the 17th of June 2015, the European Commission announced an action plan for the fair and efficient corporate taxation in the European Union. The action plan sets to reform the corporate tax framework in the EU in order to tackle tax abuse and support a better business environment in the single market. In this respect, the following 5 key areas for action have been identified: relaunching of the common consolidated corporate tax base, ensuring fair taxation where profits are generated, creating a better business environment, increasing transparency, and improving EU coordination. A further EU initiative is that of the ruling practice review. In the light of the Luxembourg leak scandal, the European Parliament established a special committee on tax rulings and other measures similar in nature and effect. Tax's main aim is to avoid tax avoidance by taking coordinated actions at the national level and achieving a better governance and transparency in the tax ruling practice. In July 2015, and after cooperating with the EU member states, Taxe issued a resolution addressing matters such as member states' approach to corporate taxation, aggressive tax planning and harmful tax practices, tax rulings and state aid investigations, state of play of EU, international and national actions, and code of conduct on business taxation. We will close off today's webcast with the dates to watch out for during the next quarter ending 31 December 2015. As mentioned earlier, the payment of the immovable property tax for 2015 with a discount of 20% and 17.5% must be paid by 1 December 2015. 31 of December has the following deadlines: the payment of the second installment of the 2015 provisional tax, the payment of the special defense contribution on dividends, interest and rental income from sources outside Cyprus for the last 6 months of 2015, payment of the third installment of the premium tax for life insurance companies for the last quarter of 2015, and payment of the fourth installment of the special tax levy by credit institutions for 2015. This concludes our webcast for today. If you have any queries or comments, please email us on cyprustaxwebcasts@deloitte.com. Thank you for watching.